Are you a teenager who's interested in investing in the stock market? Congratulations on watching this video today. If you're thinking about investing in the stock market and you're a teenager or maybe in your early 20s, that is amazing. Just to be thinking about the topic of personal finance and investing at that age sets you so far ahead in life. And by starting at a young age, in your teenage years, in your early 20s, I personally believe, because I experienced it myself, that it sets up such an amazing platform for investing. And whereas I started early in my teenage years in investing, I learned all the mistakes along the way, and I probably made quite a few mistakes in my investing career. The purpose of today's video is to share some of the insights that I've learned over the years that I think would be specifically interesting as if I were speaking back to my teenage self. If I were my teenage self again and I wanted to just hear a few things in retrospect, a few things about the stock market, these are the things that I would share with my former self. So my name is Ian Lopuk. I'm from ppcian.com, and I'm an investor. I invest for cash flow and dividends. My goal, or at least one of my goals in life from a financial perspective, is generating enough passive income and cash flow such that it covers all of my living expenses. Meaning the stocks that I own and the other investments that I own, they pay me dividend checks on a recurring basis. I can use those dividends to literally pay my bills, to pay for all of the expenses in life. So I'm going to pick up my notebook here as I do in each video. I jotted down some notes before today's video, specifically for teens and specifically for people who might be in their early 20s as it comes to investing, and specifically investing for cash flow, dividends, and passive income. So first thing I want to discuss today is this goes for life, this goes for investing, for anything. As you navigate life, I believe at least that it's always important to look at one's advantages. What unique advantages do I have? What advantage do I have that's different than someone else? I like to double down on the advantages. I like to invest in the advantages. A very unique advantage of being a teenager is you've got time, a lot of time on your hands. Meaning years ahead of you, decades, life. Life is just in its early years when you're in your teens, your early 20s. And in my personal opinion, time is more valuable than anything else. It's more valuable than money. And so just from a perspective standpoint, speaking to my former self as a teenager, one of the things that I think is really important to underscore is that, hey Ian, teenage Ian, you've got a lot of years ahead of you, so any capital you can get working for you, no matter how small, how minuscule it might be, if that capital, rather than buying the most expensive shoes out there or spending your money on a new set of wheels for your car to look really cool, if you could take that money, get it working for you in the stock market, get it working in dividend growth stocks, and hold on to those stocks for the long term, time is going to magnify, it's going to hockey stick your results in the stock market. And so I got started at an early age, but like I said, I made some mistakes. I learned along the way. I did some things right, I did some things wrong. If I were speaking to my former self, if I could have really understood at the time the value of my time in the decades ahead, boy, I would have had even more money working for me in my present day. So never forget, teenager, time. Time is on your side, and you want to take advantage of that unique amount of time that you have ahead of you, and look at it from the perspective that no matter what I can put in, it's going to compound over time because I have all those years working in my favor. So another tip here, another note that I jotted down, compound interest. Well, we already talked about this a bit, but the reason time is so important is because of compound interest. The way compound interest works is, let's say hypothetically, one can earn 7% per year in perpetuity in the stock market. Some years will be better, some years will be worse. I like to invest for dividends, so I don't really care about capital appreciation, but let's just keep it simple here. Let's look from just a total return standpoint, 7%. If you earn 7%, let's say you invest $100. If you earn 7%, you're making $7 your first year in returns. Now here's where the compounding starts. In year 2, you're not just going to earn 7% on that $100. You have $107 now, so it's a 7% return on the 107, and so on and so forth. Compound that out for, say, 30 years, and the results are staggering. Compound it out for even more. You're a teenager, you've got a lot of time on your hands until retirement, or potentially until you want to maybe take an early retirement, live off your passive income. Got a lot of years ahead of you. That compound interest is going to be your ally. Now, I want to look at some specific numbers to really solidify this concept of time and compound interest. So, hypothetically, let's just say 7% per year, pretty reasonable based on historical stock market numbers. I actually think it might be even a little bit conservative, but I like to model conservatively, and I don't think there's a need to model aggressively. So let's just look at this. Let's say you're 15 years old. If you invest, say, a starting amount of $3,000, say you work a few summers, you work hard, you're able to save up $3,000 total, and that's it. So let's say $3,000 compounded at 7%. Let's say for 20 years, you want to start tapping into your returns 20 years out. Your $3,000 investment will turn into $11,609. It's amazing. Here's what's even better. Let's say you're yielding 3%. So 3% on $3,000, you're earning like $90 a year in your first year on dividends. You pay for a few things, but it's not life-altering. After the 20 years, your 3% is going to generate $348. So say that yield's 3% of the starting yield. I'm assuming 20 years out, you can still yield 3%. That's kind of the going rate on yield. So 3% on your 11,609 is now $348 a year in dividend income. So you're 15 now. When you're 35 years old, just by taking that initiative, you're going to thank your former self, your earlier self. Your future self will thank you because you're generating, by just investing that $3,000, you're generating $348 now a year that you can either reinvest or potentially use to cover some living expenses. Now, let's take another example. Let's say 35, that's kind of early. I don't need to tap into my dividend income at 35. I want to push it out till 45. Maybe I want to have a really unique life and start traveling the world at 45, take an early retirement, and just enjoy the heck out of life. Well, that's 30-year horizon. So 15 years to 45, 30 years. Compound that 7% for 30 years. You have initial investment amount of $3,000. The $3,000 turns into $22,837. Again, this is time on your side. This is a reasonable rate of return, 7%. And you're only investing $3,000. Imagine you could do more than that. Imagine maybe at 15 you can come up with the $3,000. You can work a bunch of jobs. You can make it happen. But think about, what if you invested even more when you're 18? What about when you're 20? What about you're 25? Probably going to want to keep pouring capital into the market. But let's just say, for the purposes of this particular example, it's $3,000. That's it. That's all. 15 years old. At 45, you're going to have $22,837. And that $22,837 at a reasonable rate of dividend with 3%, you're going to have $685 a year in dividend income. That can cover a lot of bills. That can cover a lot of bills. And again, this is just a basic, simple example here, but the fact of the matter is, what I'm trying to illustrate is time. It's time and compound interest. And the $3,000, that's not the end-all be-all. That's a starting point. And that's something, maybe it takes a few summers, a few years to get going. Maybe you don't have that much at 15, but maybe by the time you're 18, you've saved it up. Doesn't matter. It's all about the time and the dedication and the persistence in the stock market. So let's move away from the numbers here and get back just into some of the basics of investing. So one of the other advantages that I think is really wonderful about teens and teenage investors is teens tend to know what's going on with the future. When you're a bit older, you're not as up to date with the new technologies. You're not as up to date with the trends, the popular trends just in popular culture. Teenagers are on top of it. In fact, they're setting the trends in society. And so you've got to look at your unique advantages in life and investing. And one of the unique advantages, other than having time, is knowing the trends. Now, I'm not saying, I personally don't like investing in trends. I like investing in blue chip companies that are going to be around forever. That being said, why not invest in the blue chip companies that are going to be around forever that are also on top of the trends? And so being a teenager, you're probably going to have a good handle on those trends. What else? Let's talk about a disadvantage. When you are a teenager, you're just getting started and you haven't made the mistakes yet. I think a lot of people in the stock market learn how I did through mistake, through trial and error. And so you probably, if you're just getting started, you haven't thought about all these mistakes yet, or you haven't made these mistakes yet. That could be risky in the sense that you haven't made the mistakes, you might make the mistakes. Now, 2 points on this. One, it's okay to make mistakes because it's better to make them when you're a teenager and you're investing small amounts of capital than when you're 30 years old or 40 years old or 50 years old and you just can't afford to make mistakes. So it's always better to start earlier than later, and that's something I'm really proud of myself for doing, is I made some of those mistakes. I had some triumphs too, but by making the mistakes early on, I limited my losses to making them with lesser amounts of money. Now, one thing that I think is important as a teenager, because you haven't made the mistakes, you might have not been through a bear market before, you haven't lost capital before, is to potentially find a mentor. Now, this is really tricky because if you're just starting as a teenager, find a mentor who would support you. And I'd rather have no mentor than a mentor who discourages you. So when you're looking out there for a mentor, obviously don't pick someone who has no experience with the stock market. Also, try to pick someone who you think would empower you and encourage you and who would be proud of you for investing at an early age, because if maybe even someone with experience in the stock market, they may look at you starting at such an early age and be like, hey, you have a lot of years ahead of you, don't worry about it. Or maybe even from a selfish standpoint, might be thinking, I kind of wish I started early, so I don't know if I want to help this person. I think subconsciously there's a lot of things that go on in this world, and so it's important whenever you choose a mentor to be careful about who you choose, and sometimes maybe it's better not to have a mentor, but in general, I believe a lot of people, most people come from a good place, so try and find a mentor who can support you and share the mistakes they've made, but also that you can run ideas past. So you might be thinking of a particular stock, they can help you analyze the stock, they can help you see the pros and cons of the stock you're looking at, and better get to the bottom of your analysis, because when you're just starting out, you might need that mentor to help point you in the right direction. But again, be careful with mentors and don't let a mentor discourage you. If you pick the wrong mentor by accident and they start discouraging you, don't give up. Don't give up. Next tip. Also, just one thing about teen investors, you're probably going to have to put in more work than someone like myself who's been doing this stuff for 20 years. I've been investing for a long time. I don't know how long, but at least 20 years. And actually more than 20 years at this point. So the fact of the matter is, when you're just starting, you don't have all those years of accumulated knowledge, so just be ready to invest some time. But that's okay, because these are the skills you're not going to learn in school. And maybe you do. Maybe some schools teach these skills, and that'd be amazing. But most schools, you're probably focused just on the basics, the traditional classes. These types of investing skills, you're probably not spending a ton of your time on. Kind of look at this as another class, or another few classes. Double down on your investing knowledge. It's going to serve you well for your entire life, because this is the stuff that can really, really matter and impact one's life over the long term. But be ready to spend some time. So next tip. Let's see. Dividend reinvestment plans. Don't want this to be the world's longest video, so I'm not going to spend a lot of time on this topic, but I love dividend reinvestment plans. These are plans offered by companies through a transfer agent that allow one to buy stock directly in the company. typically for a lower minimal or oftentimes no fee. Some of them do have fees, sometimes larger, so one has to research and be careful of the fees, but oftentimes the fees are very, very reasonable. And so the reason I like dividend reinvestment plans for smaller investors, for teenagers just getting started out, for young 20s, and for older investors as well, are the fact that they are very cost effective on the commissions, so you get more capital working. They allow one to reinvest dividends, which is key to success and that compound interest that I was talking about earlier. And they allow one to make periodic investments for low dollar amounts. They're great for someone who might not have a lot of money to start, but is adding small bits and pieces over time to build their portfolio. So dividend reinvestment plans can be great. And the stock will be in your name, not some broker's name. So when you go through a dividend reinvestment plan, it's in your name, which I think is an added bonus. So what else would I do here? I would just, on dividend reinvestment plans. When you're a teenager, I don't know all the laws on this, but one thing to be aware of is you may not be able to open it just in your name without a parent or guardian's help. So my understanding is the laws and regulations here may differ by state. I don't know, but so look it up in your own state, and you'll be guided. Like if you sign up for a dividend reinvestment plan or a brokerage account, they'll guide you through these steps. They'll make it easy. But basically, you may need a guardian or parent to be your custodian. And so your name will be on the account, their name will be on the account, they'll be the custodian of you. But don't worry, you may be thinking, hey, does that mean my guardian or my parent has control over all this money I'm investing, that it's not really mine? No, a custodian is just a custodian. The account will be your account, and once you turn 18 years old, all the money is officially yours, and the custodian can be removed at that time. So just be aware, though, that there may be a custodian involved, and that's okay, but just start thinking early on, like, who will be my custodian? Who will be which parent do you want, or guardian to be this custodian on my account? So next topic. When you were a teenager and you were just starting out, and this is something I did really successfully. So, and I'll maybe get into a little bit later about what I did well and what I didn't do well. Read. I read books. I read like 20, 30 books, like a lot of books on investing. Read those books, read the annual reports, the financial statements, listen to the earnings calls. Sure, watch YouTube videos like this one, others. Learn all you can. Be a sponge. Absorb all that information. Maybe you're going into college. Do they have an investment club, a stock club? Does your local community have a stock club? Join the club. I learned a lot in my college days at Stanford. I was co-president of the investment club there called the Charles R. Blythe Fund. Was in the fund my whole time I was at college. We brought in proposals. We were dealing with real money there, and taught me a world of information. I learned from like-minded investors all different types of things that helped over time shape me as a better investor. So just be ready to learn. And I think that's something in the early days that one has to really take advantage of, that this is the time to learn. And obviously the learning never stops, but first few years in the market, that's when to learn. So as a kind of closing topic here, already hinted at this a lot, but I invest for cash flow. If you're a teenager and you're researching stocks on the internet and you're watching videos, other ones like this, there's going to be a lot of different theories on investing. There's going to be people saying that one should trade. There's going to be people talking about penny stocks. There's going to be people talking about capital appreciation, buying low and selling high. I don't want to discourage or talk down of any approach, but I'll tell you, the approach that's worked for me has been one of cash flow. I literally buy a stock. If the stock goes up, the stock goes down, doesn't really affect me because I'm only buying for the dividend. And I buy stocks that grow the dividend over time. And a dividend is an amount of money that a portion of the earnings actually that companies pay out to shareholders in the US, typically quarterly. Best dividend growth companies grow it over time, as dividend growth investing implies. And I am generating a good amount of cash flow now. Certainly doesn't cover all my living expenses, but one day it will. That's my goal. And so I want to shape and just put this out there that don't don't write off this strategy. In fact, I think this is the most powerful investing strategy because you can't pay your bills with shares of stock. Trading is stressful. I've tried it. Penny stocks are unpredictable. I've tried it. Investing for cash flow, it can get a little bit boring sometimes, but it's predictable, it's stable, it works, it just takes time, and a teenager has a lot of time ahead of them. So definitely a strategy to consider as a teenager. And so going back, like my former self, I was dabbling actually in some dividend investing in my early days, but I would say I tried everything under the sun. I tried mutual funds, I tried dividend stocks, I did a little bit of trading. At one point I was trading penny stocks. So I tried it all. I got it all out of my system. So I was good at reading the books. I was good about starting early. I understood compound interest. But if I were to do it differently, there's two things I would do differently. One is I would just get into dividend investing from the start and never give it up, never try that other stuff, waste my time or my money with those other stuff. Two, probably would have been a little bit more frugal in my early years, and instead of spending money on certain items, I would have gotten more money working for me in the market in dividend paying stocks, dividend growth stocks. And so those are two things I do different, but I'm really proud of myself for the things I've done right as well, which is learning at an early age and getting started at an early age and finding my path towards dividend growth investing. So my name is Ian Lopuk. This is ppcian.com. If you found today's video helpful, I would really appreciate if you were able to like the video, if you were able to subscribe to my channel, leave a comment. That is the greatest compliment that you can give me as a YouTuber, as a dividend investing YouTuber here. And so also just a friendly note, this is just a disclaimer. I am not a licensed investment advisor. This is not investment advice. Today's video is just for your fun and entertainment. If you are thinking about investing capital in the stock market, please do consult a licensed investment advisor first. Thank you so much for watching. I will see you in the next PPC Ian Dividend Investing video.